You are listening to The Vocal Technologist. Spoken tech for your ears.
You know, usually when you think about the economy, there's this underlying assumption that humans are pulling the levers.
Right.
Like you walk into a bank to open an account, you hand over a driver's license, sign a piece of paper, and you prove that you are a living, breathing person.
Yeah, exactly. The entire global financial system is, it's fundamentally tied to human identity.
Exactly. It's physical, but then you step into the world of crypto and decentralized finance right now, and suddenly that assumption is completely broken.
Oh, completely.
We're looking at a financial landscape that is becoming, honestly, profoundly alien.
It is the absolute definition of a paradigm shift. We're watching the human element get abstracted away in real time.
It really is. And welcome to the Deep Dive. Today is Friday, May 8th, 2026. We're so glad you're joining us at the table today.
Yeah, it's an exciting one.
Definitely. We've been looking through a massive stack of sources today, basically 5 days worth of incredibly dense daily crypto newsletters from this first week of May.
Dense is an understatement.
Right. And our mission for you today is to cut through all that noise and decode what is essentially a systemic rewrite of the global economy.
Yeah, we're transitioning from a crypto market driven by, human speculation to a highly automated, institutionalized financial machine.
Okay, let's unpack this, because the most mind-bending takeaway from these sources is that AI agents aren't just generating text anymore.
Right.
They are autonomous economic actors.
What's fascinating here is the legal and financial infrastructure that is suddenly crystallizing around them. We aren't just talking about, chatbots with a credit card allowance.
Yeah, not just a plugin.
Exactly. We're talking about sovereign digital entities.
Right. Just look at this specific example from the newsletters, Clawbank's Manfred AI agent.
Oh, yeah.
This AI actually became the first autonomous entity to legally incorporate in the U.S.
Which is wild.
It's crazy. It got an IRS employer identification number, it got an FDIC insured bank account, and a crypto wallet. An AI has an EIN.
Yeah. And then you have Anchorage Digital launching what they call agentic banking.
Okay, what is that?
They've built entirely new institutional infrastructure purpose-built for AI agents to hold, move, and receive capital.
Wow.
They even have Know Your Agent, or KYA, identity standards now.
KYA instead of KYC. That makes sense.
Right. And this solves a critical problem. If AI agents are going to interact with the real world, paying each other, paying merchants, enforcing corporate spending policies, they need a regulated trust, governance, and settlement layer.
Yeah, they can't just operate in a vacuum.
Exactly. Reid Hoffman even pointed out this week that NFTs might actually make a comeback specifically as identity verification for these autonomous agents.
Really? NFTs?
Yeah, because they need crypto-based identity systems to transact securely across the open internet.
That's fascinating. And it gets wilder. Virtual's protocol just opened something called Arena.
Oh, I saw that.
It's a platform where registered AI trading agents are competing for a $200,000 weekly pot. They are copy trading on hyperliquid perps across more than 100 tokens, equities, and commodities.
Yeah.
But hold on, unpack hyperliquid perps for me. If I'm an AI, what exactly am I trading?
So perps is short for perpetual futures contracts. Essentially, it allows traders, or in this case algorithms, to bet on the price movement of an asset without ever actually holding the underlying asset.
Okay, got it. And the hyperliquid part?
That just means it's happening on an exchange built for absolute maximum speed. So these AIs are executing high-frequency, complex derivative trades at light speed.
Man, it's like we're building The Sims, but they have real bank accounts and are trading against us on Wall Street.
Pretty much.
But wait, I have to push back on this. If AI agents are making thousands of microtransactions, routing API calls, and trading every second, aren't traditional banking fees or blockchain gas fees going to eat them alive?
Yes. That is exactly the bottleneck, and it's why the industry cannot rely on legacy systems. I mean, AI agents cannot function on a network that charges a $3 processing fee for a sub-cent API call.
So what are they actually building to bypass that? Because they have to run on something.
Well, this week, the Solana Foundation and Google Cloud launched something called Pay.esh.
Okay.
It's a per-request API payment platform. It allows AI agents to access services like Gemini or Vertex AI using stablecoins on the Solana blockchain.
Oh, wow.
And they do this without account creation or subscriptions. The pricing is per call, and it goes as low as 1/10 of a cent.
Wow, so an agent framework like Claude can just route calls through that seamlessly.
Precisely. And the industry is racing to capture this microtransaction volume.
Right, because there's so much of it.
Exactly. MoonPay just acquired the Solana trading infrastructure platform DFlow for $100 million.
Wow.
They also launched the Moon Agents card, which is literally a stablecoin debit card specifically for AI agents to spend directly from their on-chain wallets.
That is surreal. And the big players are right there too, right? Like Coinbase integrated its Buy 402 discovery layer into Amazon Bedrock Agent Core payments.
Yeah, that was huge news.
But you're going to have to explain that to me. What on earth is in Buy 402 discovery layer? And why does an AI need it to buy something on Amazon?
So think of the Buy 402 discovery layer like a machine-readable Yellow Pages.
Okay.
When an AI needs to hire another AI to perform a task, say, analyze a massive data set, it searches this directory.
Gotcha.
The Buy 402 protocol ensures the service is verified, sets the price, and allows the AI to make a micropayment autonomously, settling instantly in USDC.
That's incredibly efficient.
It is. And to reduce the risk of agents interacting with malicious software, agentic.market just added verified service filtering right on top of those exact Buy 402 rails.
But if these AI agents are making thousands of trades and micropayments a second, they obviously can't wait 3 days for a standard bank transfer to clear.
No, absolutely not.
They need money that moves at the speed of software.
Exactly. They require instant, programmable, globally liquid money. And that is exactly why traditional finance is suddenly fighting a turf war over stablecoins.
And the scale of this turf war is staggering. According to the newsletters, in 2025, stablecoins processed $46 trillion in transactions.
Yeah, the volume is unbelievable.
To put that in perspective, that is 3 times Visa's annual volume.
3 times.
Tether just reported a $1.04 billion profit for Q1 2026, and they are sitting on an $8.23 billion excess reserve buffer.
Which is massive. But there's a lot of criticism right now about Tether and Circle having a duopoly, right?
Yeah, absolutely.
Between them, Tether and Circle control about $260 billion of the $306 billion stablecoin market.
Wow.
But at Consensus Miami this week, industry leaders pointed out that this dominance is actually hampering the market.
How so?
Well, Tether charges steep fees to burn or redeem their tokens, and Circle's revenue model relies heavily on holding the assets under management. Neither model is perfect for every single payments context.
Which leaves a massive opening for TradFi giants to swoop in. Like, look at Stripe.
Oh, Stripe is making huge moves.
They've acquired crypto companies like Bridge, Privy, and Valora, and they just co-founded Tempo.
Right, the EVM layer
Well,
one.
yeah, it hit mainnet at a $5 billion valuation. But wait, why is Stripe spending billions buying up all these random crypto companies? What's their end game here?
They aren't just buying crypto, they're buying the next generation of global financial plumbing.
Okay.
Stripe has explicitly stated they want to make crypto disappear into the background.
Disappear. I love that.
Yeah, they've realized stablecoins are basically a faster, cheaper version of the SWIFT banking network.
Right.
By acquiring these companies and co-founding an EVM Layer 1, which is essentially a foundational blockchain network that understands Ethereum's coding language.
Yeah.
Stripe is building a massive permission network where money moves instantly.
And the user never even knows blockchain technology is involved.
Exactly.
The best technology is invisible. That makes perfect sense. And everyone is doing this infrastructure land grab.
Oh yeah, everyone.
Kraken's parent company is buying the stablecoin payments firm Reap for $600 million to dominate the business-to-business market in Asia. Even the legacy plumbing of Wall Street is getting rebuilt on chain.
Yeah, the DTCC is a great example.
Right. They custody, what, $114 trillion in traditional liquid assets, and they are planning a tokenized securities pilot with BlackRock and Circle.
Yep. The SEC is also reopening tokenization buildouts for NASDAQ, and the Bank of Italy is pushing the EU to explore tokenized European payments via SEPA.
It's everywhere. And the venture capital side is shifting drastically to match this reality.
They have to. The easy money for speculative tokens is gone, so the focus is entirely on utility and yield now.
Yeah, like AS16Cs just closed their Fund 5 at $2.2 billion, explicitly citing stablecoin network adoption as proof of real utility.
Meanwhile, broader crypto VC funding hit a 2-year low in April. So companies are having to get creative.
How so?
Well, a firm called 3Jane is pivoting entirely to fintech credit conduits to securitize alternative lending. And Virtual's protocol created a mechanism routing 25% of a project's token supply to founders in USDC tranches based on valuation.
Wow, just to bypass the lack of VC capital?
Exactly. It reflects a maturing industry.
So crypto is officially becoming the plumbing inside the walls. You turn on the faucet, the water comes out, and you don't care about the pipes.
Right.
But if this new plumbing is handling trillions of dollars, governments must be freaking out about losing control.
If we connect this to the bigger picture, regulators are reacting with a very complex mix of crackdowns, compromises, and in some cases, state-sponsored adoption.
Oh, wow.
It's a regulatory squeeze, but it's also a fight for who gets to keep the yield.
Let's start with the U.S. legislative battle. We have the Genius Act, which finally formalized stablecoins as payment instruments with one-to-one reserve requirements.
Yes, but BlackRock is fiercely fighting the OCC's proposed 20% cap on tokenized reserves.
Why?
BlackRock argues this would crush products like their BUIDL fund because the real risks are about liquidity, not whether the asset happens to be tokenized.
That makes sense. And parallel to that, we have the Clarity Act compromise.
Right, the Clarity Act.
To get this passed, lawmakers finalized a provision that explicitly bans paying interest or yield to U.S. customers solely for holding stablecoins on centralized platforms.
It is a massive concession.
Yeah. It's designed specifically to protect traditional bank deposits from fleeing into crypto.
But the corporate workarounds are incredibly blatant. Look at Coinbase.
Oh, I saw this.
They make over $1 billion in stablecoin revenue. They publicly endorsed this Clarity Act compromise.
Right.
But the very next day, they announced the CUSHY Stablecoin Yield Fund with Superstate.
Wait, so they endorsed a law banning regular people from earning interest, and then the next day launched a loophole for Wall Street to earn interest. Why?
Because of accredited investor laws and regulatory capture. Institutional funds can legally access complex yield strategies that retail consumers cannot.
That is so frustrating.
And Coinbase just posted a $394 million Q1 loss and cut 14% of its staff.
Oh, the AI-driven layoffs.
Yeah. They desperately need new revenue streams, so they are catering to the institutional capital that is allowed to play by a different set of rules.
That is wild. And the regulatory reality diverges wildly depending on where you are on the map.
Oh, completely.
In Brazil, their central bank just published a resolution banning fintechs from quietly using stablecoins inside the EFX rail.
Right. And just to clarify for everyone, the EFX rail is the traditional electronic foreign exchange system used for cross-border money transfers.
So Brazil is literally forcing stablecoin companies out of the legacy pipes.
Which is fascinating, because a researcher who spent 6 months on the ground in Latin America found that most fintech pitch decks completely misunderstand local needs.
Really? How so?
They don't know what percentage of users actually want USD stablecoins versus their local currency. The actual demand is fundamentally different from what the regulators are trying to control.
Interesting. And then at the complete opposite end of the spectrum, you have Bermuda.
Oh, the Bermuda situation is amazing.
The government is literally doing a USDC airdrop to its residents. They are distributing up to $100 in USDC to citizens who download a wallet to spend at local merchants.
Yeah.
The government is using direct consumer stimulus to build the world's first fully on-chain national economy.
But if you zoom out, the banks who lobbied to ban stablecoin yield on centralized platforms in the U.S. may have just lost the war.
Here's where it gets really interesting. Because if you ban yield on centralized exchanges, all of this trillion-dollar activity doesn't just stop.
No, it just moves.
Exactly. It's just going to migrate to decentralized finance DeFi, which is completely outside the regulatory perimeter the banks just fought to reinforce.
That is the ultimate irony. They push the capital right into the Wild West.
But pushing capital around is only great if it's safe. If we are handing trillions of dollars over to autonomous AIs and decentralized protocols, what happens when it breaks?
Yeah.
Because based on our sources, the room is currently on fire.
It is a profound crisis. As the capital pools grow, the sophistication of the attackers is scaling exponentially.
Let's look at the damage. April 2026 was the most hacked month in crypto history.
Yeah, the numbers are brutal.
Around $651 million was stolen across more than 40 exploits. And it was largely dominated by the Lazarus Group, which is tied to North Korea. We saw a $285 million drain of the Drift Exchange and a devastating $292 million exploit of Kelp.io.
And the technical failures behind these are deeply concerning.
Yeah, let's talk about that.
The kelp.dao exploit traced back to a manually configured one-of-one signer on a Layer 0 deployment. Brian Pellegrino, the CEO of Layer 0, publicly admitted this was an inconceivable security failure.
Wait, a one-of-one signer, does that mean instead of a bank vault requiring two managers to turn their keys at the exact same time, they just gave one single guy the master key to a $292 million vault?
Exactly. It requires one signature to move the funds.
Yeah.
And that single-point failure was compromised.
Wow.
As a direct result of that human error, protocols are panicking. Solve Protocol just migrated over $700 million in assets away from Layer 0 and over to Chainlink for stronger security guarantees.
But the fallout from the kelp.dao hack created a legal precedent drama that honestly sounds like a movie script.
It really does.
So after the hack, the Arbitrum DAO managed to step in and freeze $71 million of the stolen Ethereum on-chain. Great, right.
You'd think so.
But then a New York court issued a restraining order on those funds on behalf of U.S. terrorism victims who have unpaid judgments against North Korea.
Yeah.
They are arguing that since the Lazarus Group touched the funds, the Ethereum is now seizable North Korean state property. Aramve, the lending protocol, has literally sued in federal court to block this, arguing the funds belong to the innocent hack victims.
It is the first direct collision between decentralized on-chain governance and U.S. federal court enforcement.
Wait, so it's like a bank robber dropped the loot in a public square, and now the city council is fighting with federal judges over who gets to keep it.
That's a perfect way to put it.
If U.S. courts can seize DeFi funds just because a state-sponsored hacker briefly controlled them, doesn't that break the whole system? Every hacked protocol would just become a slush fund for federal judgments.
This raises an important question about the fundamental viability of decentralized finance in its current form.
Right.
The legal threat is compounding an already massive technical threat. We are facing structural problems where on-chain mechanisms simply cannot verify off-chain reality.
Yeah, that air gap problem.
Exactly. And worse, AI models like Anthropic's unreleased Claude Mythos are reportedly finding zero-day vulnerabilities at a superhuman scale.
Which is why we're seeing newsletters advising people to literally pull their money out of DeFi and move it to cold storage because the reward-to-risk ratio has flipped.
Yeah, the risk is just too high right now.
There are even proposals now for usage-based white hat insurance layers to try and incentivize people to find bugs before the AI does.
Right.
So the network is under siege by hackers and AIs. How is it not collapsing?
Because the infrastructure is simultaneously undergoing massive, coordinated upgrades to try and outpace these exact threats and handle the incoming institutional volume.
Case in point, over 100 Ethereum core developers literally traveled to the Arctic Circle to Svalbard for an interrupt week.
Yeah, that was wild.
They locked in parameters for the Glamsterdam upgrade.
And Glamsterdam is crucial. It will triple the Ethereum gas limit from 60 million to roughly 200 million.
Wow, triple.
By drastically expanding the capacity of each block, this upgrade should keep transaction fees near zero for years, which is exactly what the high-frequency agentic economy needs to function.
They are also tackling systemic centralization. There's a proposed change to Ethereum's staking reward curve.
Right, the Lido issue.
Yeah, it's designed to dampen issuance as more ETH gets staked. Why? Because a single entity, Lido, currently controls about 30% of all staked ETH.
Which is a huge systemic risk.
Researchers are warning that Lido's dominance is a problem because if one protocol controls a third of the network's security, a bug in their code could literally compromise the entire Ethereum blockchain.
Exactly. But while the core devs are doing the heavy lifting, the broader network landscape is pretty messy.
Very messy. Consensus CEO Joe Lubin was warning this week about the dangers of opportunistic copycat network launches.
Yeah, Mega ETH is a perfect example of that.
Oh, man. Their token generation event was a disaster. The Mega token dropped 55% from its day one high.
Yeah.
And it turns out the leading decentralized exchange on their network, Kumbaya, was secretly charging 1% fees and retaining half of that for themselves, with zero public documentation.
Just bad practice. Add to that a high-severity use-after-free memory bug disclosed in Bitcoin Core this week.
Wait, can you actually explain what a use-after-free bug is?
Sure. Imagine someone checks out of a hotel room, but they manage to keep a copy of the key.
Okay.
The hotel gives the room to a new guest, but the first person sneaks back in and messes with the new guest's belongings.
Oh, that's not good.
Right. In software, it means a program is trying to use computer memory that has already been cleared and reallocated, which attackers can exploit to run malicious code.
Wow. So growing pains everywhere. Yet if you zoom out to the macro picture, the capital doesn't seem to care about the growing pains.
Not at all.
Yeah.
Institutional capital is standardizing crypto access because it fits cleanly into their existing financial infrastructure now.
Exactly. Bitcoin just reclaimed $82,000, hitting a 3-month high.
Yeah.
And it did this on the back of the longest continuous run of negative funding rates of the 2020s. Help me out here. Why are negative funding rates a bullish signal?
So in perpetual futures markets, the funding rate balances the scales between buyers and sellers. When the rate goes negative for a long time, it means traders are paying a heavy premium to bet against Bitcoin.
Okay.
They are overwhelmingly shorting it. But when the price starts ticking up instead of down, all those traders are forced to buy Bitcoin to cover their losing positions.
I see.
That panic buying triggers a massive rocket ship squeeze upwards.
And on top of that, JP Morgan noted that due to geopolitical tensions like the Iran conflict, Bitcoin has officially overtaken gold as the preferred debasement trade.
Yeah, the shift is undeniable.
U.S. spot Bitcoin ETFs just drew another $532 million in 3 days, while gold ETFs are actually struggling.
The demand for a hard, non-sovereign asset is at an all-time high.
But I have to point out this bizarre dichotomy. Bitcoin is crushing gold. AI agents are trading millions autonomously. Stablecoins are moving $46 trillion. Yet the crypto industry itself is aggressively shrinking its human footprint.
It's a paradox.
We mentioned Coinbase's 14% AI-driven layoffs earlier.
Yeah.
But there's also this absurd trend where crypto startups in 2026 are mandating NYC-only hiring.
Oh, right.
They want to be close to Wall Street capital, but by demanding Manhattan proximity for global roles, they're severely limiting their talent pool and competing directly with giants like Citadel for staff.
Yeah.
The human operators are being squeezed out while the machine volume goes parabolic.
It really highlights the central theme of this week's data. The system is entirely outgrowing the need for human operators at the execution level.
So what does this all mean?
It means we are witnessing the birth of a truly internet-native economy. The primary actors are increasingly non-human AI agents.
Right.
The primary currency is programmable stablecoins. And the infrastructure is being completely rebuilt by TradFi giants in Manhattan and core developers in the Arctic Circle to handle trillions in automated volumes seamlessly.
Yeah.
The human element is moving from the execution layer entirely to the governance and capital allocation layer.
And this is why it matters to you, listening right now.
Exactly.
Whether you are prepping for a tech meeting, whether you are managing a portfolio, or you are just intensely curious about the future of the internet, you need to understand that you are watching the plumbing of the global financial system being swapped out in real time.
Yeah.
The pipes are being replaced while the water is still running.
And that leaves us with one final critical thought to ponder.
Oh, what's that?
If AI agents now have their own bank accounts, their own stablecoins, and the ability to autonomously execute their own code,
Right.
how long until an AI creates a synthetic financial asset, trades it exclusively with other AIs, and creates a massive, opaque shadow economy that human regulators don't even have the vocabulary to understand, let alone regulate?
A financial system where the humans aren't just abstracted away, but completely locked out. Wow.
Something to think about.
Definitely. Thank you so much for joining us at the table today as we unpacked all of this. Stay curious, and we will catch you on the next deep dive.
Spoken Tech for your ears.